Okay, guys, it's quite late at night, and I thought I'd come to camera while I'm having my chocolate, because we all know Scruffy likes a coffee, but it's late, so he's having a chocolate tonight. And I did a video this morning, which was an update about my Vanguard, and it's taken an almighty hit over the last few days. Um, and let's just say it was lambasted. Oh, you should have known this. You should have done that. Oh, people are losing money left, right, and centre. I genuinely think some have missed the point. Um, Downvoted to hell and you name it, one thing. I kind of knew it would come anyway because you've always got the armchair pundits. Now, when you're investing, which is what the Vanguard is, I'm not looking at it the same way I do as a day trade. But if I did, what you've got to remember is if I'm looking at a 15-minute chart and it spans out quite a way across the screen, well, if that was a monthly chart, it would probably be about 20 years worth of data if every candle was a month. So you've got to think of it that way. And what do you do when you day trade? Well, you look for the highs, you look for the pullbacks, you average into the pullbacks, and then you get the acceleration if you've got the direction right. That's kind of the way I day trade. Now, the same principle is in the investment, but I'm looking at that over 5 to 10 years, and it'll be closer to 10 than 5 years because it's part of a retirement pot. I want to give my grandkids a good lump of money for when they're of an age of buying houses, which they will be when I'm about 65. And I want to take Joanne around the world. So that's what I'm doing with it. Okay. So let me just show something, but I also want to put some maths into this. If we look at the current scenario, it's pushed up, it's come down, it's pushed up. That is a blip on the horizon. So to say that you would have seen that a mile off, no, you just keep averaging into it. Okay. Yeah, there was a correction due. And was I worried about it? No, I don't chop and change the funds because if I start taking money out here, that means I'm losing everything that's already in it. What I want to be doing is averaging into it. And I couldn't give a monkeys if it came all the way down here and then I will buy it all the way back up because it'll make money. And I'll show you the maths in that in a second. Now, there was a comment about saying how it took 13 years to recover from 2000. It wasn't even close. Wasn't even close. So if you look at the pattern here, so you've got your 2000, it continued to move down, it pushed up, it moved down. And yeah, if you were doing this on short term, it's pretty darn scary, right? But you should never invest into these things short term. They've got to be 5, 10-year programs, even 20 to 30 years if you're putting it in as a pension, which is what I'm doing. Now, I have cheated a little bit. I've actually got DeepSeek to work this out for me. And it's using the current chart that we're looking at. And it's going to show the investment if you started in 2000, so 1st of January 2000, and you ran it through till the 31st of December 2013. And you were just constantly putting in £100 a month into it, or $100 as this is worked out, what your contributions will be, the low points, the high points, and what the end would be at 13 years. Now, if we pull this down, you can kind of see, all right, your first couple of years, you're sort of probably shitting yourself. Oh, no, this is no good. This is no good. But if you're looking at monthly charts and thinking of them as a day trading chart, well, you're only sitting in it for a few hours. It's not a big issue, right? So you've got to think big term, not small term. This is where people make mistakes. They think so narrow field, they can't see the big picture. So yeah, you lost, right? You get your max drawdown 2002, which is what I just showed you on that curve. The recovery begins. Well, come 2004, you break even. Right, so you're not only break even, you're actually got a cumulative return of 13% on your money. So if you were doing a 5-year plan, you got 13% back on your money. That is better than what the banks are giving you at the moment. The banks are giving you a percent of the year. So it's outperformed the bank. Okay, 2005, you got good profit. You got good profit. You get your peak profit 2007 when it was on that rise running up. And you've got a colossal amount of money, which is fantastic because you've already got them units banked in. Okay. The market crashed in 2008. We all know this. Down it came, but it recovered very quickly. And you were not only back to profit, you had a good amount of money at 23% at that point. You were then profit, 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 all the way up to 13. So you didn't have to wait 13 years to get your money back. The money was always there. You just had to be patient in how to get it out and ride it out. But you had to have it on a longer term plan. And as long as you have that in your mind, you're fine. Now, there are ways you can ride through that. Now, the S&P is a single index, and it's North America. It is the main way that it works. I use global indexes. So if the global economy drops, doesn't matter where you've got your money, you're going to get caught with it. All right. But it also smooths things out because it's everything. And I have two. I've got the FTSE All Cap, which is a global index, smooths it out because I'm a good believer in you buy the haystack, not the needle. And then the smaller of the two, the one that I'm doing with the small account challenge where I was growing it from 200 quid. It's only lost 700 quid off its five grand. So it's not a lot of money. And it can bounce back very quickly. That one's, it's an all world as well, but it's based on emerging markets. So it's heavily influenced by India and that sort of thing. So really what I wanted to do was kind of show you where the numbers are. Now, if we just flick this back just a second, it actually starts bringing out various different scenarios. So your portfolio dropped 2,500, you invested 3,600, and you think, oh my God, this is absolutely horrible. But it started to recover all the way. You were fully recovered by 2009. And then when you hit your final balance is huge. All right, you had a good return on that. And then there you go. And the takeaway is very simple. The DCA process that I use, despite two crashes, 2000 to 2008, you ended up with a plus portfolio of 82%. The time it took to recover was 4 years. In a long-term investment, it's not really an issue, not really. And the thing is, if you put even more money into it, you would have had a bigger return as well. So that took into account, as it says, the dot-com bubble burst, and then reinvest your dividends, and you are sorted. So when you're looking to do something, don't think short term. If you're thinking short term, stocks and shares ain't going to work. You've got to hold them for quite a while, and it will pay off. All right. Now, in 5-8 years' time, when I see it peaking, that's when I'll start looking to shift it over, and I'll move it into cash, and I'll put it into a gilt, whatever, doesn't really matter. But I'll cross that bridge in 6-7 years' time. Now, if all the money's gone, well, then you can say I was wrong. But history, right the way through the ages, and even going back into the 30s, when in the 29 crash, they do recover. And when they do recover, they come back with some gusto. So the only way you would have had to have waited a long time is if you just put a bit of money in and then never added to it again. Then you'd have to wait. But what I was speaking about in the video and what I speak about all the time is dollar cost averaging. I constantly drip feed into it for a bigger and better return. So I hope that kind of makes sense. I know people are going to argue with me on one thing and another. And I'm not a financial advisor. I'm really not. This is just my own personal viewpoint. And it's personal things that I do. I couldn't give a toss what you do. So you really shouldn't care what I do either. Just a thought. Anyway, as always, guys, trade well, keep your risk managed. And in this case, look after your own risk. But as always, do what you love and the money will follow. See you all in the next one.